Bonds are simple, interest-only loans. It's that simple. Unlike a stock where little is promised, but the potential reward is unbounded, with a bond, everything is spelled out and you don't get more than that. If we draw it as a picture, we're going to expect interest payments over regular periods, but none of the principal is repaid until the end of the loan. When the borrower is a bank or credit union, these agreements are called certificates. When the borrower is a government or corporation, these are called bills, notes, or bonds, depending on the length of the loan. They have a face value, which is the amount you'll get back at the end of the term of the agreement, and a coupon, which specifies the fixed dollar amount that you'll receive every year as interest in either monthly or semi-annual payments. Bonds with longer terms or poorer credit ratings need to offer higher coupons to attract investors. The coupon rate never changes. This is the reason bonds, like CDs, are called fixed income investments. What makes these different from an IOU or loan or even a bank CD is that these are negotiable, meaning you can buy and sell these in a market for the current price. It's a competitive market, and that price is determined by the prevailing interest rate for similar bonds. There's only one day when the price has to be equal to the face value of the bond, and that's its maturity date. Interest rates move around daily. Today's interest rate for a 5-year Treasury note is around 1.5%. 30 years ago, it was over 15%. The credit rating of the issuer is very important. Many corporations with outstanding credit ratings also issue bonds to raise money. Corporations with weaker credit ratings need higher coupons to attract investors, so these are called high-yield bonds. Now, as always, beware the marketing. While high-yield certificates are good because they are government insured, high-yield bonds are bad, at least from our point of view, that it's better to use high-quality bonds to stabilize your portfolio and keep your risk in the stock market investments. Because in addition to default risk, junk bonds tend to go south when the stock market tanks, exactly the wrong time. Now it's time for some fun. I'll give you 2 facts. You choose the fact that's true. Here's one. All bonds are subject to interest rate risk unless held to maturity. Here's the other. Bond prices vary with interest rates, but do not grow like stock prices grow.